Hey everybody, welcome back to the second section of swing trading future spreads. In this section, we're going to go through the actual traditional ways of looking at charts, which is using line charts. These are the traditional spread traders charts that we use to look at relativity between contracts. One contract minus another creates a relative price differential on our price axis. So we're going to go ahead and go into this step. Now, the prior section showing candles and swing trade ideas off of regular traditional charts and high time frame is very important too, that you take that into perspective. A lot of traders end up switching their ways eventually, and I like to introduce different perceptions to the market, to the traders. So you may end up just swing trading outrights in the future. You might have the capital to do so. Using the section before this can be very helpful for you. You might consider doing futures options. Okay, so that's overall looking at the way most technical chartists look at the markets. Now, in this section, we're going to dive into how spread traders look at charts. Okay, so we're going to be using the tools today, TradingView Pro Plus, and now it's going to require Pro Plus because there's intraday spread chart capability in Pro Plus. And obviously, we're going to be using Futures Plus TradeStation as our broker to enter, exit, manage our trades. So let's go ahead and let's dive in. All right, here we go. So we're on a line chart on Pro Plus. We're on our crude oil, and crude oil's taking a beating. We're down to $18.27 a barrel. Okay. I'm running this session on a weekend because that way it slows down all of this simulator in the market on the brokerage side, and I can show things to you without it moving around. And so it'll make sense because there's tick value differences when it comes to spread reporting and closeouts and things. And when you go into the weekend where things start looking funky, because remember, it's recording the price of two calendars, November, December in this case, and I'll get into that where we'll create the chart. And I'll explain that why it does funky things like that on the weekend right before the market opens again. And once the market opens, there's usually a fix because there's tick reporting differences. So this is the thing I've noticed with TradingView, and I want to bring that up. So we're on crude oil, and I want to create a spread. In this case, the November, December. So I put my CL, I put my November contract, I do a space minus the December contract, and you'll learn all these letters. I still don't know all these letters by heart. I just know the ones that I normally will bring up. You'll see on the side here, you have the composite symbol, CLX 2020 minus that, and it's showing minus 52 is where it closed. Now, this is where it gets real tricky, because I'm showing a negative 3.1 on anything from the 4-hour chart and under, which usually is quicker in response. And anything from the daily and up, you'll also notice the spreads are they don't go back that far. So it's harder to chart any patterns here. You can maybe do manual things like draw some horizontal line maybe there. Maybe here, whatever, right? But then things got all out of whack recently. But when we go under, you see here the 5.2, which is it's confluence with this. But when you go lower, anything under the daily, you start getting 0.31. Now, why does 0.31 make some sense with me? In my simulator, I've closed out at a 0.31, and why is because I bought this thing at a negative 0.52 during the daytime on a Friday. I'm sorry, where did we go? Right? Okay. Now, remember, this is going to move way slower. We're way at the end of the year, and we're doing tight months. I explained how that works in a different section. And so it'd be normal to just only make a tick or two or whatever as the market makes these big swings, right? We're doing really conservative trade. But 3.1 makes confluence with this because if I sold at 0.52 and we closed at 0.31, then I'm up 13 ticks. Sorry, let's do the math together. We sold at the 0.52 and we closed at 0.31. I'm sorry, 21 ticks. So it's showing a difference, a relative difference. 340 minus 130 is $210. And then crude oil trades at $10 a penny. So $10 a tick makes sense. But when the market opens here, you'll see also the dome, the depth of the market is frozen. You have a 100 contract just sitting here, lying here, probably an algorithm. You have algorithms here just waiting to hold price right when the market opens Sunday to hold this spread down. We'll see what happens. And usually what can happen is market will open, and I've gotten messages about this. Hey, Pete, right before market open, it showed I was up $1,500, and then it went back down to like $10. Well, because that's where probably the market really is, and they're hashing tick values out. But again, between two contracts that far out, that's just how it's worked. It's been years. I haven't figured out the best way to explain it. So and I just started using the Pro Plus version for these spreads too. So there is, and you'll know that is delayed when you try to add, let's say, an alert anywhere for this. It'll warn you too that the spread may be triggered differently than you expect because the tick data of price movements within a bar is not included in historical bars. And it's two different contracts. So using that, I like to focus on 4 hour and down for now. Okay, because this is going to get the fastest data, and it looks like Futures Plus has also picked up that data. So we're going to go with that on training level and understanding and building your levels and your charts and stuff versus the super high time frame. What I want to utilize the higher time frame for is to pick other areas I might want to just draw manual lines on. Now, why? Our dynamic support resistance tool that we're currently using, well, okay, it did it there. It didn't do it a lot of times before. It's limited on drawing that stuff. Definitely doesn't do it on weekly, monthlies. So as you get into daily, you can see that it does things like that. But we're going to use 4s because that's where we get more price ranges. And obviously, you guys, a lot of you know, most spreads, with the exception of this craziness that happens, is very mean reverting. So here's where we can start taking advantage. Now let's talk about the fun part, okay? How do we exploit these things? How do we make potential money on these things? And so yesterday, I went ahead and just went long around here on the simulator to see, if we can hit a target of up here. And the market showed that it closed up higher. Crude oil itself hit a bottom. Our technical view, maybe real quick, could have been, okay, it's a good place to buy. And we see price bouncing a lot within this trend line here. Within this channel, within this range of 60 cents and 30 cents. So we have opportunities to make up and down 30 ticks up and down in this range. One of the rules we can use, again, is, if you had an order here, is when price got around here, you can just go ahead and stop on out. You can reverse try to go the other way, which we've only done a couple of times in this time frame because it's happened before. So you're just building channel and probability. Can I trade, up from these bottoms up and try to close at reasonable areas before it goes back down? Can I reverse my position and trade in these ranges? So it can get a little tricky, but as you get, comfortable with the rhythm of it, your probability of making more over the course of your losses should be really good. In this case, we're trading a very far out. It's currently April 18th. You see my calendar down here on my computer. April 18th. It's a Saturday morning, gorgeous day in Austin. And obviously markets closed, so I can record this comfortably. But anyway, point is, it's April. We're looking at November, December contracts. Now, in the prior section, we were talking about trading contracts up front and one contract behind it. Now, I want to give a real quick warning again, guys. Remember, that's a very aggressive way of trading. The closer you come up in the contracts to the front month or spot month is what people want to call our current month, which is we're in April. Crude trades always 1 month forward, so May. That May contract, the closer we're trading that stuff, see here, let's get back up to the top of this market grid, May, June, where all this volume is, you're going to feel that much more punch of the move of crude oil. And it's, and I've simmed this and back tested these versus later months, and it gets very aggressive. So you got to make sure you have the risk tolerance for these things. And that's why I say it's important to sim trade them to know the difference. The conservative traders that want to get a good piece of this action here are out here. You can still see great volume. As you see, this stuff trades way far out. I'm all the way down November, December, November 20, December 20. Here's the pricing. So I think market will open and this price should fix here on my P&L, and it'll go to what the higher time frame is saying. That's what I'm assuming still. We'll see. But that's not the point. The point is the volume and the safety of trading these things. There's volume here. So there's people that are thinking the same thing. Make 10% of the regular move of crude oil, and this is the way most spread traders will trade. So let's go ahead and look at another example. Maybe this wasn't the best one. I just kind of want to make you guys aware too, especially for you beginners. And one more thing before we move away from crude oil, just key thing. Remember, guys, on the simple side, okay, we don't have to explain this like an institute. If you look at the price axis on the right side, when these things range between, on average, minus 0.65 up to minus, 0.16, back and forth since April 7th, okay? So like the last 10 days, each range, more or less, and you could have cut it here and draw us another line here and maybe, I'll just use the manual one. And maybe in this range, these zones, okay? So you could have traded up to this thing, up maybe like more or less 20 ticks, down about 20 ticks, up about 20 ticks. Down here, you would have gotten a gift. You would have probably got out anyway. Back up when it broke through, you're up in the area, 20 ticks. Some of them you'll miss. Some of them you'll take little loser experiences by a couple of bucks, but 20 tick up, 20 tick down for a week range before things get changed. They're gonna change eventually, and when they do, you're gonna take a loser. And then until you start finding new ranges. And here's just my point: 10 tick up and down, 10 tick up and down, $100, $100, $100, $100, $100, and things like that. Some of these might be losers because you're trying to find the new range, and in the midst of it, you're gonna take some heat because you're trying to find it. So that's my point: is coming in here and can we maximize this without using any seasonality, just using line charts, a spread chart between the contracts, coming out here and comfortably putting on your trade. Now, another thing, putting on the trade on this depth of a market, people ask a lot. Just using a left click mouse, guys. Later on, you can use this on your mobile phone. This is available on your mobile phone. If I clicked right now, like this price, right now market's closed. Liquidity's a little off the table. Normally these things are here in the hundreds and there's no spread in between. You see, there's a depth of market spread where there's a price of 0.53 where there's no buyers or sellers. By clicking on this right here, this blank one, if I'm a seller and if I want to aggressively sell this down and I don't want to sit here and be in line with this guy. So let's say I wanted to sell and I left click, I put in my one order, I left click, I have to confirm, and it puts me in line. Over here you see a 1 working sell order. Okay, I'm in line. I became number 3. Let me take this back off real quick. See it disappear. I became number 3. I'm at the meat market. I picked a number. Next. I'm next. I'm number 3. Okay, until several of these buyers come up and say, fine, no one's going to settle here at 53. I'll come up and I'll pay 52. I wanted 54, but I couldn't get it. I'm going to buy 52. They have to buy those other 2 people in front of me's 52 before I get 52. Okay? Now, if I know something in the market or I'm antsy-pantsy, and I just want in aggressively to sell in against these guys, I'm going to take probably a 1 tick spread loss, you see? Because I'm just saying, I'll jump in front of these 2 guys. I'll come over here. Okay? So I'm going to give myself a slippage of 1. But I'm sitting here now. Well, actually, I put a resting order because no one was there. However, if price was, if I wanted to be aggressive about it, left click again, cancel, I could just come straight here. This is going to be considered now a market order. If I left click and right away come down to 54, I'm surrendering. I'm not becoming a resting order, a resting place saying, nope, I'm a limit resting order. I'm a market order now. By left clicking here, it even showed it filled me on a simulator. So see here now, my position is net -1. I'm selling this thing now. Okay, I'm a seller. I'm a net seller of one spread. And so therefore now, if I want to say, well, I want to buy it back and cover, I'll make sure I have one here, and then I'll put it here. So I want to buy it back at 54. I want to scratch this trade. I bought it at 54, but now I'm going to go behind that guy. I'm second in line. Let's say something happens. I just feel like, man, I made a big mistake. I need to get out quick. I'm going to have to give up, one tick and come in market order, which is the blank one always above. And that's considered, let me left click here and get out. That's a market order. It's going to give me an immediate fill at a slippage cost of one tick in this case. I'm sorry. Again, because this price right now, guys, there's a big gap in between. There's one spread gap. It's going to still be considered resting order. Let me cancel that. The market order is at the oops, gosh. This is the market order. Sorry. Right here. So I want to buy back that one aggressively and close it back out there. It's going to give it to me right away. But what happened? I aggressively came down here. I jumped over this guy and went over to 1 and 2 tick. So I took a 2 tick loser getting into the trade. And that's kind of like taking that extra money loss when you take market orders like that, because you're not waiting in line trying to get the price you want, the fill you want. You're just jumping ahead. There's a price to pay for that, and it's a slippage cost. You're going in market. You're going to pay for the spread difference plus the one tick. Especially right away if it moves against you up here. Now you're left behind. You were trying to sell this thing down. They're buying it above you, and you're already 2 ticks down. And then you decide, I messed up. I want it out. Now you're 2 ticks up. So you took $40 loss plus commissions just sitting here doing that. Just so you know how that works. Okay, so, but anyway, that's one thing there. But just so you guys know, what can you do? What's the potential here that you can do all week long? This was starting from the week of, again, April 7th, when it came down here and started picking up a range. And up and down. And so you don't have to trade those aggressive months with one contract. Come in here and trade multiple contracts if you have the size for it, the risk tolerance, and you have the account. Actually, your risk tolerance is more safer over here than doing a single lot way up here. You're going to feel that burn. I told people in the old YouTube video, the closer you get to that front month, you're going to feel that burn more. And then the more you spread them apart, you're going to feel it too. So it's going to be, these guys here, they're pretty aggressive. These guys here, this volume here. So, there's a reason why there's a lot of people in these calendars. There are like 104,000 contracts, guys. And again, because it's weekend, you won't see that here. Come Sunday Central, 5 p.m., they'll pop up here, and it'll be hundreds per ratio. So sometime walk backward into the spread and look on your depth of market. Another note, a hint, okay, to see if, look where the major crowd is. There's a reason there's 104,000 people here in the June, July. Instead of trading way out in, the end of the year, you might want to pick this one up. And then you just build that. You build that contract. And that's June, July. If I'm not mistaken, that's M 2020 minus CLN 2020. Okay, 438, 439. Where are they closing here? This is more or less correct. 438, 43440, 104,000 volume open there. And here's your spread. That's a 2 hour. This will work down into a 4 hour. Well, it's not as clean for us, right? That just looks too. See if we could build something off of that. And there you go. So, is this a good buy? I personally think right now it's pretty darn obvious, right? I think a kid can guess. Prices are really, really cheap. This could be a good contract to buy up and try to make a run from here and just ride this baby up even. Just take a contract, maybe 2 or 3, pull one off over here at 80 ticks movement. Second contract up into there. And this is if you're multi contractors, another one up into there. I mean, you can play this on for months and you just running that. And you have all that time. May, June. Nope, you have rollover possibly happening here too, is what's going on. So you have all this time here. This contract's going to come up soon from this. So be mindful of that. You're going to feel moves in here if you're in this one. But what's your chances? So that's that. Let's move on to something else here, guys. I want to really, guys, I hope that I'm not taking too long in this stuff. I like to give away as much info as possible. This stuff means a lot to me. And so I want everyone to get the most of it. I take my time a little bit with it. Just as if, we're sitting down here together like friends, just going through this stuff. So that's one thing. I hope you're learning off these things, and I'm just taking my time here with it, guys, and hopefully you guys get a good little lesson out of these things, because you can make a great living off this, or side money or whatever. Let's go ahead and pick another commodity. Let's look at Eurodollar. This is one that I'm just really been getting into a lot lately. I've simmed it a lot. I've seen good results on it. It's super liquid. It's basically the 3-month interest rates is the front part of the yield curve. So I've learned that these are really good products to spread trade, and I've been seeing results. So this is the outright. I want to go ahead now and do a spread on them. They trade quarterly, although they have weirdly some monthly contracts too. But they are quarterly by design. So again, I want to go into, come all the way down and look at, since they're quarters, SAPDEES. Now look, you see SAPDEES has 12,130 contracts. There's reason to that. Okay, that's good. So there's volume there. So September is going to be U. So we'll go GEU 2020 space minus GEZ 2020. And that's going to create our September, December Euro-dollar spread. Okay, let's look at 4 hour. Does this make any sense here? Does this make sense? Let's click there. We see 0, last price 0.00. Kind of look over there. You look over here. This kind of makes sense. And it trades in 0.005 weird little ticks here. And each tick is $12.50. So there we go. This makes sense. Okay. Let's see if there's that. Okay, this is making sense here. This is not as violently running like crude oil, so therefore there's no discrepancy in the daily to hourly price, because crude is just one monster of a mover. All right, well, that makes sense. So we're all good here. So earlier in the week I had put on a trade here up in this area around April 9th or so, and we got up in this area, and I bought the spread, sold it off, and it made about close to $100. It wasn't that bad of a trade. But how can we put this in line with even like an actual chart? Let's go here and look at maybe like a daily, okay, where we can see, obviously everything is all out of whack lately, but let's say we wanted to see 16th of March where it hit this high of 99.73. Just look to add confluence. And this was that week, okay? So there was some highs here. So if we got into these highs and said, Well, price on the outright looks okay. The chart on the daily looks like we're way up there. We wanted to take a short or whatever. And down, just that little move, that conservative little move, it would have been somewhere around here. Could have got you somewhere like, oops. And you would have probably got in here. It would have pulled back against you about 3 ticks. Okay, and then it would have came back your way and made about a 15 tick move. So, and these things trade, guys, at contracts like 3,000. This is just because of after hours. When this thing opens up, it trades in the thousands per price. You'll see this thing go up drastically in the hundreds and hundreds, and this is still a lot of liquidity for a far out contract month that's just sitting here resting on when the session is close. So these are probably like algos, 999, 997. They use funky numbers. But if you were holding 10 contract up, you could have been down, $300-$400 drawdown. And if you even hopped out here at the peak, you could have came back in and did this nice move down here, and you would have known exit areas. You see these levels, right? Where's price been before? And we had a good long here, April 8th. Let's say, okay, here we go. Our dynamic support resistance lines have drawn over here. It's in a good zone. 1, 2, triple bottom almost. Maybe even 4 times. But again, zones. Remember, zones mean an area, guys. It doesn't mean an exact price, okay? It doesn't have to hit a tick. This is like a couple of tick difference here. 1 or 2 tick difference. So we're in this zone in a good buy area. Could have said, okay, I'm going to buy this damn thing up. And it was April 8th. And got this thing up another 10 tick up. So it's like 10 ticks times 1250, guys. It's like $125 for 1 week of work. Just sitting there. It's working for you. And spread cost is super cheap, like a couple $100 or something like that. So, you almost double your span margin of your good faith deposit money up. And if you could have 10 lots on this thing, and the market wouldn't have noticed who you are at all. And so my eyes personally are really glued on euro dollar. The thing with euro dollar is they say it doesn't move like this most of the time, but when it moves like it trends, it will trend. Look at how this son of a gun can move in trends. So I have a swing trading suggestion for this that I'm going to come up with, and it's just pretty much follow the 100 EMA, and when it's on the other side, go long. When it's on the other side, go short, and then just watch your contract expirations, because you're going to be in this thing for a long time. So there's a lot of ways to really, different little ways to play this. I think the euro dollar has good opportunity, but again, it's a lot of bankers and stuff in here, so it's very trendy. A lot of people that want to game, like little gamey people on the market, they don't try to play in here because it's hard for them to game it, because this is a very powerful volume trending thing. This is from what I am hearing and seeing is a spread trader's delight. So this is the way you can trade euro dollar, is just do the spreads and on the spread charts, find a good zone, find a good area, trade your zones, trade your areas. Make sure you're on the right contracts, that you put the right contracts, and that you have volume there. That's it. That's as simple as that. All the other guys that want to sit there and talk, a lot of fundamental nonsense, I apologize if anyone's in here that sees that, hears this. You don't need it. You don't need to know who's doing what, who's where, who's doing, you need to be worried about your own things, because that's the most important. I like to trade, but I don't try to figure things out. It's none of my business. I just want to take the money off the market when it's being there yelling at me, screaming at me, and, telling me come and take it. That's all I want to do. I used to do this stuff with cattle and hog. I kind of toned it down. I don't want to teach it no more either. It's really thin market. And plus there was some ethic stuff personally that was coming into my life with it. So, it is what it is. If you wanted to just look at it, let's go ahead and wrap up with looking at a line chart on cattle. I don't really suggest it, but let's take a look. Let's go ahead and just do it manually because I don't even save it in my list anymore. Cattle. Okay. It's April. Okay. Cattle is one that can really range in price between 130s and 110s for quite a. I'm sorry. 80s are really low. I was gonna say like about 100 and 130s for quite a while, and it's been doing that. If you look at our line candle chart, almost for years. That's just the pattern of it. Okay. So go back to my blue. So like from this areas, it's a sweet spot. And so, looking at an outright, you can go, okay, when the outright price gets around here in 130, I wanted to short it. And I have a cattle rancher I personally know here in Texas, and he was asking me about this. And we talk since this area. I'd see that. Okay, that was around like January 13, mid-January, right? So let's build a spread on that. Let's pick some months. Let's see, what will we pick? Will we pick LE? Let's look at a month that has something. See, I took it off from here, guys. I don't have it here anymore. Told myself I wasn't going to mess with it. June, August has some volume. This is why I don't want you guys in this stuff. It doesn't have any volume. So June, August. M versus Q. Okay. LEM 2020 space minus LEQ 2020. Okay. There's a spread. Let's go down to 4 hours so it looks like it. Look, and guys, we're recording this during this COVID time frame and all this stuff. On top of it being so, cattle being so thin in liquidity, it's been erratic. Even I lost some money. This was like one of my last cattle trades during this time. Okay, so mid-March, we were up here. Price on cattle on this spread was around minus 0.60 mid-March, and you take a short off the highs of the regular outright where you see, a nice channel. 1, 2, 3, 4 quadruple tops, 130s being a high. Always sellers kept coming back into that. And you took this spread, which looks ugly, but it doesn't matter because where you stand, and it looks like a resistance was built here on this spread, by the way. Broke down, came up resistance, and you took this short all the way down, and then it gaps on you and stuff like that. So this was over like, it could have been conservatively 5 points, 6 points, and cattle trades at about $400 a point. So this was like a $2,000 trade, and it whipped around. And it could have been. It's just, that's the reason I don't want to teach it. But I'm showing this for the spread traders out there for the purpose of this little video, for the heck of it. Some of you aggressive guys out there to see the potential. On hog and cattle, you can make quick money because it's very thin. And when it moves, it moves. But if you take a high probability trade like that, that's something I would have taken just by myself. And also, we've hit these bottoms, and right now it's been really good trades. I've simmed it to feel it again, and they're really well. I mean, they're hog, cattle, they dropped because all this COVID stuff, and finally they said, okay, China's going to start buying these things again. They've always been saying that for years now. And it would have been, just a rock bottom purchase. And anyway, but just selling it off the top, off regular price action, okay, 3 years worth. Okay. This is December 17. 3 years worth of top and bottom. Come on. What's the odds? Okay. This is a high probability trade off the top of 130s on cattle. You can use divergence. Divergence traders out there. Price is straight line. Stochastic is moving down. There's some technical analysis. We're at a high. Come in here, build up a spread, and sell it. Okay, whatever these lines do, as ugly as they look, they're doing what the price action is intended to do, which is make you money. You're on the right side of that trade. You're down here now in the per contract $2,000 profit. That's that kind of nature of stuff. This is the spread trade section, guys. I hope that everything was pretty clear. I gave a few examples. We built these line charts here. I built my little section called Forte Trader Spreads because I have an intraday section. I do things for my daily cash flow. We have our swing trades. We're going to get into the bonus sections later, and like with Forex, or we'll be doing this. But this key thing here, this is where you should really be able to put your money and make a bang for your money, if that makes sense. Bang for your money. Hope this section helped a lot. This is a key section to this course. Okay. Again, you're gonna need Pro Plus for TradingView. Unfortunately, for budget-driven guys, I'm sorry, but this is about one of the most priciest things you'll pay for within this course. Noticing that your brokerage is offering you data for free, your platform for free. We use this for charting, and so therefore, having the right tool is really, really, really good. I don't see a lot of people offering tools like this. So anyway, that's about it. We'll catch you in the next section. Thanks for watching.